There has been a slew of studies released recently on the dangers our generation faces in retirement from underperforming pensions over the next few decades. Some of this is due to worries about future market returns. A lot of it is due to employers making such miserly matched pension contributions. The main danger, though, is that most people will take no action to address any of these issues, or will act on it too late.
In this video, we've gathered up the findings of multiple reports that highlight the dangers heading down the road. We'll remind you of the importance of prioritising your pension and the consequences if you don't. We'll look at some shocking statistics about pension awareness. And finally, we'll tell you what you can do about all of this to get back on track to a comfortable retirement. Let's check it out.
If you want to grab some free cash, check out the offers page at moneyunshackled.com. Invest Engine, LoanPad, Easy Money, Octopus Energy and others are all giving away £50 in welcome bonuses. Free stocks are available too. Changing assumptions of returns. The FCA has been revising down its assumptions in recent years for the future expected returns of stocks and bonds, with stocks only expected to make 4% real returns, that's after inflation, over the medium to long term.
To get an idea of how this might affect a pension's performance over a lifetime, Interactive Investor have recently run some numbers for a mixed portfolio of 60-40 stocks to bonds. What would once have been a future pot of £131,000 based on pre-2008 levels of returns has been revised down to around £85,000 using the current assumptions.
The takeaway from the report is that this could be remedied if pension contributions were higher. The minimum pension contributions in the UK from auto-enrolment are 8% of qualifying earnings, based on 4% from you, plus 1% from the government, plus 3% from your employer. The report suggests that this needs to be raised to 12% in order for this generation to retire in the same level of comfort as the generations before us, who enjoyed much more favourable market conditions.
The downgrade in returns is based on work done by Credit Suisse and others, who are currently suggesting a 3% to 4.6% range of real returns over the medium to long term, compared to the rates we are all familiar with from the stock market of the past, like 7.1% for baby boomers. The analysts are basing their assumptions in part on historically low interest rates, which gives them a super low base for forecasting bond returns. They then added on a risk premium to get to an expectation of stock market returns.
If the analysts are right and you don't take any action, you may need to push back your retirement date to try and make up the difference. 69% of people have no plan B for what they would do if this question became a reality, with only 10% prepared to delay their retirement. When asked instead how long they'd be willing to delay retirement due to their pension being too small, a majority of 60% gave answers of less than 5 years.
But 5 extra work years is unlikely to be enough to make up for a lifetime of underperformance. And in any case, if you're unlucky, you may already need to delay your retirement for another reason, which is sequence risk. If you are unfortunate enough to approach retirement age in a market downturn, this analysis by JP Morgan shows that you would be wise to delay retirement even if you had started your 30-year-long investing journey in a market boom, represented by the blue line here.
If you had the double problem of having to delay retirement to deal with sequence risk and having to delay retirement due to decades of mediocre returns, you might find that you can never retire.
Getting your priorities right. Here's a reminder of what we're all working towards. Analysis by JP Morgan shows what people do with their daily hours at different ages in their lives. The key change is the transition from work to socialising, leisure and exercise that happens at retirement age. Perhaps most important is that you are investing into a pension at all, and from an early age, into the right assets. This chart from JP Morgan shows the difference between 4 hypothetical pension savers starting and finishing at different ages. The chart is in dollars, but you could substitute pounds for the same story.
Consistent Chloe invests $200 for 40 years, starting at age 25, earning 5.75% annually from the stock market, and ends up with $369,000. Late Lila does the same, but starts late at age 35, and amasses only $192,000, almost half as much. That is the cost of starting late. This next chart shows another danger of starting too late. Volatility is far higher over a shorter term. These bars show the range of likely outcomes for returns if you invest for 1 year, and you see the range of outcomes gets tighter the longer you invest for.
If you start focusing on your pension at age 50, there's every chance that your return could be negative by age 60. You've not left it cooking for long enough. You need to start a good 20 years or so before retirement to bring the range of potential returns down to sensible levels.
But if you haven't yet started paying decent contributions into your pension, there may still yet be hope for your pot, so long as you are still early in your career, according to JP Morgan. This chart shows the difference between a 10% and a 3% contribution into a workplace pension, with your employer matching up to 5%.
Super Sam consistently contributes 10% for 40 years. Stubborn Sarah contributes 3% throughout and understandably has an abysmal pension by the end of it. But escalating Ethan starts out with 3% contributions and raises this gradually over his first 8 working years to 10%. He finishes not far off Super Sam, so according to this chart, if you're just starting out, it's not too late to course correct.
Lack of awareness and lack of information. A study looking into transparency in UK pensions had some interesting findings. Firstly, and shockingly, 48% of people didn't know or couldn't guess to a ballpark figure how high their pension fees were.
You can't control the market, but you can control your fees. The difference between a 1.1% pension fee and a 0.1% pension fee could mean the difference between a 4% and a 5% return, potentially snowballing into a retirement pot difference of hundreds of thousands of pounds.
I had further cause for disgust to read that 22% of 18 to 34-year-olds have a low-risk pension. For instance, by investing a majority of their retirement money into bonds. These people, frankly, are all screwed. Bonds have a woeful long-term track record when it comes to growth, and only those approaching retirement age should consider holding a significant allocation in them.
32% of people don't know whether their pension risk changes automatically as they age. Many pension plans de-risk over time by adding more bonds, but many don't. If you are risk averse, you don't want to get to age 65 and find that your pension has been cut in half in a recent stock market crash because you'd failed to set it to invest more into bonds as you age.
People know very little about where or how their pension is currently invested, but a big part of the blame is down to the workplace pension providers themselves, who do little to make it easy for people to understand.
The study found that there was common frustration and surprise amongst pension savers that asset class, sector and geography information was not available in their pension documentation.
Here's a representative sample of the feeling of the study's respondents. On sectors, I had to look at a document from 2006. On risk rating, it didn't give me a good grasp of what risks there are. On investment split information, isn't it so obvious it should be there? And on fees, it feels like it's being presented in an opaque way.
Finally, some people are working against their own interests by holding too many separate pension pots. 15% of people have at least 4 pensions and a further 6% had lost count. We think it's almost impossible to keep track of what's going on in your retirement pots if they are scattered across various providers, especially if your only interaction with them is a vague paper statement once a year.
What you can do about it. This handy retirement planning tool lays out what you can and what you can't control so that you know what to focus on. Totally out of your control are market returns. If Credit Suisse's forecasts come true and we're in for a couple of decades of low returns, there's nothing you can do about that. Nor can you influence government policy on things like tax.
Where you do have some control is on your employment earnings and how long you work for, which is also linked to your health and longevity, but you have total control over these factors: your savings rate and your asset allocation and location. Let's look at your savings rate first.
The obvious thing to do to ensure a comfortable retirement is to increase your contributions to your pension. If your total contributions are currently 10% and you could stretch that to 15%, then that's a simple solution. But still, you're fighting an uphill battle if your asset allocation and location are poorly chosen.
With location, this is referring to where you hold your pension, i.e. with which providers and funds. Workplace pensions tend to have high fees, and recent changes announced in the November 2021 budget are set to make these even higher. Where you hold your pension matters.
Your understanding of what's inside your pensions will be benefited if you could combine all of your old workplace pensions into one place, preferably one that also lets you choose your own funds and therefore asset allocations.
All three of these problems, fees, essential location and asset allocation, are resolved by use of a SIPP or self-invested personal pension. Check out the SIPP information page on moneyunshackled.com for overviews of the best SIPPs on the market and some guidance about how SIPPs work.
When you come to choosing your asset allocation, this interesting comparison shows that a more diversified portfolio can actually have a higher return than a less diversified portfolio and also have lower volatility. Spreading your money to include investments like emerging markets and small caps is in theory a superior strategy to only including large cap stocks from one country.
The comparison went further and looked at how long a highly diversified portfolio would last in retirement versus a less diversified one. A portfolio of cash is also shown as a benchmark. The less diversified portfolio ran out of money after 30 years of withdrawals, while the diversified one was still going strong.
Another solution for improved performance is to apply some leverage. Pension and investment platform Interactive Investors' youngest and oldest customers have a higher preference for investment trusts. Investment trusts tend to outperform other funds in a rising market and underperform in a falling market due to the use of leverage or borrowing. Consequently, these two groups have the best success amongst all users of the platform in the 12 months to the 30th of September.
Not enough people are willing to use leverage in our opinion, even in small amounts. Another way to add leverage to a retirement portfolio is with buy-to-let property. 19% to 22% of people who invest on Interactive Investor also own buy-to-let property, according to this study, but only 4% of people considered it to be their most important source of income in retirement.
But the survey also highlighted the regret amongst retirees that they did not own enough or any buy-to-let properties. A typical response was, "I should have had the courage to buy my first buy-to-let earlier." Finally, we'll leave you with some other regrets cited in these reports by retirees. Regrets of taking expensive financial advice, of placing too much emphasis on safety, of choosing income over growth, of being too afraid of risk whilst young, and of not being financially literate.
Question of the day: what do you still need to do to get a grip on your retirement finances? Join the conversation in the comments below. Thanks for watching! On this channel we'll talk a lot about personal finance, investing in all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.